There are people who talk about financial freedom, and then there are people who are actually living it. My guest today, Bridget Brick, is one of those rare individuals who has mastered the game of wealth building and entrepreneurship. She's done it all, helped startups scale to multi-million dollar valuations, built her own successful businesses, and now she's revolutionizing the way investors get into real estate. But here's the kicker. She walked away from a lucrative career because she realized that something was missing. She wasn't just chasing success, she wanted impact. Bridget is here to break down exactly how she helps investors access smarter financing and why traditional loans don't always work, and the mindset shifts that separate those who struggle from those who scale. If you've ever wanted a behind the scenes look at how real entrepreneurs think and build wealth, you're in for a treat. Bridget, I'm so happy to have you here.
Thank you. Thanks for having me.
Of course, I've been following you. I see how much you work. You're a real hustler. You're all over the place. I see it and working so hard. But I definitely want to know your early days. Like, what drove you to pursue a career in real estate, and what sparked your passions to help others scale their portfolios?
Sure. So, really, when I was a child, my family is very close, and there's a contracting business in my family. So, they would build houses and, build investment properties, commercial buildings, etc. So, when my cousins and I were young, we would always run through the 2x4s as the homes would be built. So, I was always fascinated by the building process and just homes and interiors and beautiful homes in general. And interestingly, I landed in a role selling at university doing loans. So I started doing loans while I was at university, and we would use these green and white, they were called AS400 printout sheets. And we would have to call, like telemarketing call, smile and dial these customers to try and convince them to come from an adjustable rate mortgage to a fixed rate mortgage. And so I was super successful at that. I mean, I would just always play these games with myself of like, okay, call, okay, how many calls can you get? And I was always one of the top 3 salespeople. Now that landed me in the management position before I graduated, which really set me up for my career after graduation. But interestingly, I went away from this industry. I did pharmaceutical sales, and then I moved into the tech industry. I did that for about a decade. And after a lot of success in the tech industry, I mean, one of my projects was with the New Zealand Trade and Enterprise Office, where they had me launch 3 New Zealand telematics companies into the North American market, into the office of a company they bought. They had me author a playbook, and interestingly, I got to use that playbook as the foundation for my tech consulting company because it's a foreign entity. And although I wrote it while working for them, being an international entity, they didn't care about keeping the copyright to it. So usually if you work for a US entity and you create something like that, the entity or the company who paying you owns that copyright. So I got to keep the copyright. That was the basis of the foundation for me founding my company, the Accelerate Group, where I helped startups as a COO on demand to scale their company to be attractive for Series A funding. And I took one of my clients from a group of 230 participants up to number 6 in a seed round to raise funding. And really after that project was done, and this is also 2020 when everybody's kind of like taking a step back and reflecting and just kind of stuck indoors. I took a step back and realized I'm good at what I do. I mean, I had won San Diego 40 under 40 the year prior. I was one of San Diego 40 under 40 the year prior. I realized that I was good at what I did, but I didn't like it. And so I asked, why I really wanted to dig deep. Why don't I like this? And the truth is, I was really only helping a few small group of people, maybe the group of the founders at the end of the day become extremely wealthy, but I wasn't really participating in the collective, and I wasn't really doing anything that I felt could contribute to a person, an individual's everyday life to get better for their family and just for society. And so I just kind of threw my hands up for the second half of 2020 and said, whatever's meant for me, I'm just going to let it flow to me. And so for the next 6 months, I just traveled with my friends. And I say that because we lived in Southern California at the time, and my friends and I, and it was very boring. Everything was closed. You had to wear a mask from, standing at the outside hostess table all the way to sitting down, but all outside. Like none of it made sense. So through this group of friends and through traveling, met a brokerage who they were so busy with all the loans that they were doing, these DSCR loans that they were doing, for investment properties that they really needed to scale. And I said, that's what I do for a living. That's what I've been doing. I've been scaling companies and setting up their operations so they could grow. So I ended up doing that project for them. I ended up becoming a loan officer for them and working for about a year until I met a client who had a different need. And that's what sparked me to open my own brokerage once I found the capital partner who could provide the type of loans they needed. So it's interesting how when I was young, I was around homes, and at university, I was doing refinances, and then it brought me full circle back. Once I took a step and really reflected on my life of what I want to be doing, it brought me back to loans, because the type of loans that I do, they don't look at income, tax return, or employment to qualify an individual. So it makes it really easy for the everyday American to access the type of loans needed to get into investment properties and into passive real estate income and appreciation.
That is so, so inspiring. And you said so many things. I wrote so many notes. I loved it.
Thank you.
Most people that aren't entrepreneurs perhaps don't value the power of a good playbook. I think your success and how you mentioned that with such pride, but I didn't want to gloss over it, because as an entrepreneur, working without a playbook or with a playbook is the difference between a perhaps 200 point place in an accelerator or being sixth. Like, that's the difference between maybe just like luck success and real success, is having those playbooks. And I also liked how you gamified your work. You said I called and I wanted to see how many people I could call and how many people I can close. And where did this come from? Is this something
I've
you learned?
always been an overachiever. Now, I mean, if you want to get into the spiritual side of it, if you really want to dig into, there was one point in my life where my father made me feel like the only way to get love was to be performative, to be the best, to have the highest and best, to make the best grades, to whatever, right? And so when you look at trauma or where it comes from, it can go one of two ways. Some people go over here in the deep end and have this and have it project into their lives in this way, and some people go over here in this end and have it be overachievement in every possible regard that they can manage. And so when that little trauma, that little tiny inkling of an idea was installed in me when I was young, maybe 5, 6 years old, everything I did then had to be the best and had to be the best that I could achieve. And when I was 5, my Barbies weren't just playing, my Barbies had businesses. And I really don't know where that came from. I think that's just who I always have been. So whenever I do something, I like to go deep, not wide. And what that means, that's part of the playbook too that I used for my tech consulting, that I still use in this business that I have in the brokerage. I want to go deep with what I want to go deep with what investors need in terms of loans for investment properties. I don't want to go wide and be doing primary loans and vacation loans and all these types. I want to know exactly what you need as an investor, and I want to go source the capital partners for every step of the way. And one example of that is the BRRRR loans. That's the buy, renovate, rent out, refinance. And so you're going to need a renovation loan, and then you're also going to need a refinance into a perm loan. And so, we just have that whole range of products we go deep down the line. We go down one lane and we go all the way that we can go. And so that's really where it comes from is you want to be the expert in whatever it is you're choosing to do. Now, I had a cookie company at one point, and then I had a cabana rental business, and then I had a tutoring center. And so I always went deep. I didn't try to spread myself too thin with each one of those businesses.
Super, super valuable. I love this is like a highlight for this podcast. It's like my Barbies had businesses. I absolutely love it. And now I see your mentality. And also something that's not very talked about these days is tough love, how that tough love brings.
Mm-hmm.
In my case, I had very tough love parents as well. And when I tell people stories, they're like, how are you not crying about this? I'm like, I am thankful every day that my parents pushed me as hard as they did. And even till today, they still think I could do more. Like, I'm like, okay, when is the finish line? But I love it how they keep moving the goalpost. And I see that I connect with what you just mentioned of, parents that instill in you that to get love, you need to be the best. But I don't think it's really that. It's like they see the best in you, so you need to deliver.
Right, right. It's interesting how it's interpreted, and you can turn it into a trauma, which makes you do this. When in reality, you're right. They just wanted the best for you.
Yeah. And then parents are the only persons in the world really that want you to be better than them. Your friends want you to be better, but maybe not than them. So it's like, they are really the only ones that have that instilled. And I thank you for sharing that past, because I think it's very important to who you are and who you've become. For people that are not in real estate, can you explain why traditional financing doesn't work in some cases and why you decided to take more a DSCR loan?
Sure. So traditional financing requires an individual to be underwritten, meaning you as a person need to show that you make enough money to cover the cost of whatever loan you're taking. So say you already have a primary mortgage and you're kind of maxed yourself out with that with your debt to income ratio, you wouldn't qualify on paper for another mortgage because the bank would be saying, where is the money going to come from? My loans don't say, hey, we want to underwrite you as an individual. My loans don't look at your income, W-2s, tax return, or employment. My incomes look at the income that my loans look at the income that the property will make. So my loans are looking at property as a business. And so we're still pulling your credit to get your FICO score. You still need 20% down payment minimum. Now that's more than conventional loans. But what you don't need is to prove with your income, W-2s, tax return, or employment that you can afford this additional mortgage. And so that really allows a bridge between you have conventional loans where you either don't qualify or you've maxed out. And then you have cash. You can pay cash. So before these loans came along, there was really no bridge between these two. And these loans, these DSCR loans that I offer the bridge between the two. They require more down payment, but they still let you leverage money to get into real estate investing.
Yeah, I see. And what type of properties are there that you underwrite better? So I understand that traditional loans are based on your income,
Mm-hmm.
and really they underwrite you. They don't the asset is a collateral or a second collateral. Here you're using the property as the primary collateral. You'll have I guess, a first lien on the property. What trends or what type of properties do you think, or do you underwrite more favorably, and which ones are you staying away from?
A person needs to decide, an investor needs to decide what strategy and how much risk they want to take and how much reward they want. So if you have low down payments, you don't have a lot of money, and you want high cash flow, you would choose to get into Section 8 investments. And that's going to be properties that cost around $100,000 or less because you can get into them for 20% down payment. So let's call it $20,000 plus closing costs. Not a lot of money, relatively speaking, to other property choices. And these can cash flow anywhere from $500 to $1,000 a month. Now, there's a little bit of risk in that you have to make sure you buy a good property because at that low cost, there could be repairs that need to be made. So get an inspection done, right? So that's option one. Option two is you have a little bit more money and maybe cash flow doesn't matter as much to you as more appreciation. So obviously when you buy a more expensive property, the number on the balance sheet, the appreciation is more than the property that costs half, right? So if you care more about appreciation over time, maybe you would buy a mid-priced market rental. So you would buy a property where the market rents are just covering the mortgage cost. And so maybe you're into that for $40,000 or $50,000 down payment plus closing costs. Now, if you have a little bit more money and you want high cash flow, so we went from low money, high cash flow to a little bit more money, hardly any cash flow, to now you have more money but you want high cash flow, you might consider something like a short-term rental. So those are going to cost more because number one, you need a nicer property that attracts people to want to rent them. The second thing is you're going to have setup fees. So depending how much you want to put into the look of the home to attract your renters. And now with that though, you can make quite a lot of cash flow. So there are a lot of short-term rental coaches that teach you how to maximize the profits on your properties. So now maybe you're into something for $100,000 down payment, 80 to 100,000, but you're making 5, 10, 20 grand a month in cash flow. So you really have to choose your strategy. Now we underwrite all those scenarios. You can buy the property as vacant if you're doing a purchase. If you're doing a refinance, we really need it to be rented or we need there to be historical incomes to show that you've been receiving money. If you don't have it, we do have options, but they're not as favorable terms as the other ones.
I Thank you for that explanation, because I think our viewers, our people, and me have learned that there's so many ways to play the game.
Hmm.
Famously say in my team, I'm always drilling the same thing, is that there are no bad markets, only bad strategies.
Hmm.
And what you were mentioning is like, how do you want to play the game? How much risk do you want to do? Where do you want to make your money? What's your ultimate goal is very important to how you underwrite a loan, and also work with that sponsor, I guess, with that person.
Well, it's the strategy, right? Everything that I've ever done in life, including becoming the manager at that telemarketing company, was a strategy of mine. I set out in the beginning because there was one class I attended at the beginning of my university when I started at university. One class where the speakers came in and said, if you've ever worked for a copier company, so like Xerox selling copy machines, or if you've ever been a telemarketer, we would hire you in a heartbeat. So I thought I've got to go find a telemarketing job, because at the time I didn't want to go knock on doors selling copiers. I'll just call the phone, right? So not only was I a telemarketer to set myself up, but I said, oh, if I could just get management experience, that would set me up even further. So back at year one, I had a strategy that landed me at year four. Right now, when I graduated year four, the only reason I got hired in the company I got hired in is because I had the management experience. I instinctively knew that before I even graduated, right? Because look at all the other people who are telemarketers with me. What puts me above everybody else? So when you're investing or when you're trying to make money, you have to figure out what is your end goal, what are you aiming towards, and then you have to take daily action and make daily decisions that will lead you maybe a year or 2 or 4 years from now, but you have to start today.
I'm writing so many notes. I am learning so much. I think you're particularly powerful in the way that you were 10 steps ahead of everybody. You say, okay, if
Yes.
everybody's going to get hired, if everybody that works in telemarketing is going to get hired, but how can I differentiate myself? It also means having managerial understanding. So then when it gets there, they're going to choose me because I'm obvious. How did you learn that? Did you have a mentor? Is there someone that impacted you the way you thought about this, or has it come intuitively?
My family, when I was young and going through school, elementary, junior high, and high school, were blue collar workers. Now, my family switched me from one school in junior high to another. So I went from being around other blue collar worker kids as my peers to being around kids whose families had gone to college. And these kids all had the nice houses in the country club and the nice cars, and I didn't have that. And so I looked around and thought, well, why did they as children get to have this experience? And that's an experience that I want to have as an adult. Well, the common denominator is that they all went to university. And so it's through observation, right? And I've never missed anything in the market simply because I've been observant. The cookie company I founded was ahead of its time. I mean, now you've got like Crumble and all these other really cool cookie companies, but when I founded mine, they were like 4-inch cookies, and they had these massive chocolate chips, and they had this drizzle on top of these sprinkles, and everybody threw a fit over them. I created that company because I had a foreign exchange student come into town for 6 weeks, and I took her to all these 6 different cities, and I could never find, I wanted to give her all these American experiences, right? And I thought, what's so American, like chocolate chip cookies? I couldn't find a good chocolate chip cookie anywhere. It felt like every time we went into a bakery to get a cookie, they were like thought about afterwards. They were left over, they were dried out. It wasn't like the staple. And so I was like, I'll figure out a good recipe and I'll make a company. And that's what I did. So it's just being observant to what's around you and understanding how you can get there. And what is the common denominator? What do you have to do to put yourself in those same rooms or to achieve that same outcome that you see?
Yeah, talking like a true entrepreneur. I think the entrepreneur doesn't look for the money per se. It's more like there's a gap in the market. I have a problem. And
Yep.
it's true. Like you would say, when you wanted a chocolate chip cookie, like Subway cookies came to mind. Like, you have to go to a sandwich shop to get
Yep.
a cookie that was good. Now there's so many, and you're right. The gaps, and then you try to go for it. Your experience and all the time that you've been an entrepreneur, what do you think are mistakes entrepreneurs are making today?
I think I'm going to go back to the deep, not wide conversation, because what I learned when I was working with tech startups that I ended up putting in my playbook and that I have used with every company I've had is you have to go all the way down a lane or three not more than 3. And then you can open up other lanes. And I'll explain it like this. I would do market launches for tech companies in the beginning of my career. They would choose like 3 to 5 major cities and they would launch. So I worked in the healthcare field where there's all these different specialties. There's probably 12. They would launch 3 specialties in 5 cities. And once those were maxed out, then they would open up an additional 3 specialties that we could sell to in those 5 cities. Once those were maxed out, then they would open up 3 to 5 B cities, go down 3 specialties, while allowing those A cities to then go down specialties 7, 8, and 9, the additional. So see how they went deep first. And the reason is if you go deep, you can spend your marketing efforts and money going down one lane and making sure it's penetrated. Then you're going to take your efforts and spend it somewhere else. But if you try to go wide, you will completely deplete yourself of any marketing efforts, any money, any resources that you have. And that's how companies go under. They think, well, my total addressable market in tech terms, that's called the TAM. We're talking about TAM, SAM, SOM. My total addressable market is my home market, and I want to address and market to everybody. And my total available market, or my sales available market, I'm going to put marketing out to everyone. When really you've got to pick some specialties or niches within there and then go deep, allow yourself to start getting revenue. Then you can go address the other markets that you want to pull in and bring revenue in from.
Super, super, super insightful. I wrote it down. Deep first is important because I agree with you. Most entrepreneurs today will use sort of like boilerplate words like I am an AI focused company, like,
For
or
what? What are you
crypto,
doing?
blockchain, AI focus. Don't, what are you? And I think the days of the entrepreneur that does that are over because money is more expensive, investors are more sophisticated. You cannot raise money through a PowerPoint anymore. It's more like how can you prove your decision? And the only way to do that is having the one product, or you said up to 3, that makes money, or that has like a proven concept that says, okay, you understand cookies, chocolate chip. Now let's try to do chocolate chip cafe or a chocolate chip, whatever. And I like your idea of what you just mentioned, the growing of lanes from A to B cities to C cities, and that propagation, very, very smart and very important
The second
advice.
thing I would add is to have structure. In my very first business, which was the cookie company, I was throwing stuff against the wall. Honestly, it was like having an MBA. Creating my own business and not having any idea what I'm doing, especially in the food industry, which is very difficult, was an MBA in itself. I didn't need to pay any university for the lessons I learned. But in that, I really was messing up in the beginning for the first 9 months. I really didn't have any structure. I was allowing anybody and everybody to order online, and then we would make the orders when they would come in, and then we'd send them out. It was very inefficient. And once I went to bed on the 31st of that year and woke up on the 1st, I said, something has to change. I'm working 19 and 20 hours a day, sometimes getting 4 hours of sleep. And I had a full crew, a full team, right? But I realized I needed to Kanban my systems. And what that means, it's like the Henry Ford, like one person makes one part and they only make that part, and the next person makes one part and they only make that part. And then slowly, as you go down the line, there is a fully truck that's built. With us, I decided to Kanban my cookie company. And what that meant is we would take all the orders in up until midnight. Then the next morning we would make all the orders that had come in and we would send them out to not only the cafes, but also shipping to customers. So then all day long we would sit and wait on all the orders to come in, and we would get them by midnight, and the next day make the orders, send them out, replenish the inventory. Right? So now my team has specific jobs that they're doing, and I'm not wasting money standing around for orders to come in and just standing there when orders aren't coming in, right? And so I created a structure, and that moved my profit margins in the food industry into 75%, which is almost unheard of when you have a food product. But that's the difference between just throwing stuff against the wall and kind of like running around with your hair on fire and putting actual structure in place.
Absolutely. Doing these podcasts, I spoke to someone that said, do you have a theme for the year? What are you thinking? And my theme of the year has been all about systems, because it's all about how can you create a, like you said, a structure that is leveraged? Because you cannot leverage, and there's a pun there with what you do with loans. You cannot lever haphazard. You cannot, because you'll only explode. You'll only go 1,000 ways in the wrong direction and get completely, perhaps, some motion sickness. But if you're very systematized, that can be levered. You could put 1,000 people to do the same thing, and then you'll get the results. Moving from your entrepreneurial philosophy, which I think is amazing, let's go into your investment philosophy. And I want to separate like the DSCR loans and the philosophy of how you invest there, but how do you do it on your personal level? What decisions, what goes through your head? You said you observe when you're an entrepreneur, but what do you do when you invest?
So I'm going to pitch this back to the audience and say, because I don't want to get caught up in projecting someone's situation onto what I do, because my scenario is very different. I've been through a divorce, I'm single, all these things, right? So I would recommend looking at what outcome it is that you want, and asking yourself what exact investments are going to get me there. So for me, it's important for me to diversify more my portfolio, not only in real estate, but also in life. So this is my main business. I have a team that works for me. And this is the main source of revenue for this business. And then secondly, there's real estate. So I've got my family to consider. And the way that we structure our business is there's a trust, and then there's a holdings company, and then the real estate is in LLCs. Now, what I recommend is that every LLC not have more than $2 million worth of real estate inside of it. And then the way that we have the beneficiaries and everything set up is going to benefit once my mother passes away and I'm taking that over for tax purposes. Now, I highly recommend that you have a tax advisor in place when you're doing something like this and you're setting up that kind of structure. Then separately, I have my consulting company. And then another company, I can't announce it yet, but it will be coming this summer, which is sort of more in the hospitality and social industry, not so much in real estate or investing. So for me, it's always been about diversifying my portfolio. But I think the most important thing for your listeners to keep in mind is you want to move from a passive role in your retirement and your income and your revenue to an active role. And what that looks like can be scary, but this is the recommendation behind it. If you have your money in a 401k and you're sending your money off to other people to manage, that is a passive role. You are hoping that they will, whoever they is that manages your money, will come up with a way to generate a return for you that will set you up for retirement. If you move that money out of your 401k, and yes, I know there are penalties associated, but keep in mind with a 401k, you are paying money in that someone matches and you're limited to what you can pay, but you still have to pay for it. If you take that money out and you put it in real estate, your renters are paying for your retirement. Your renters are paying the monthly mortgage on the property that's going to appreciate that leads you to retirement. And I say that because say you buy a rental property, say you don't make any cash flow, but you're always making appreciation. At the end of that 30 years, you can cash out that equity for no tax. You can cash out that equity tax-free. So say you have just one property and it's gained $500,000 in equity. That can be your retirement money tax-free. Yes, you're going to put another loan in place, but your renters are going to pay that mortgage, right? And you keep it, and then you put it in the trust. Don't sell it before you die because there's taxes. You put it in the trust, it gets passed down to your family, right? So now they get to own that property. And then in 30 years, they can take the money out tax-free. So because money in the form of a loan is tax-free. So you want to work with a tax advisor, you want to have a good CPA and tax strategist in mind, and you want to always be thinking ahead, like, what am I going to do what is my future self going to do for my present self? Or what is my present self actually doing for my future self, is what I meant to say. So what is my present self doing to set up my future self for retirement and taking an active role in that? I don't want to get to my future self and look back and be like, what was past me doing this whole time? So the biggest thing I can recommend is to move to an active role in investing in your revenue, in your retirement, and to ask yourself what types of things can you invest in that is going to not only achieve your present goals, but achieve your future goals.
I really, really like your answer and your philosophy because I wrote an article maybe a year ago saying that everybody needs to have a family office.
Mm-hmm.
And it's not only for the ultra wealthy, it's not only for people that actually need to manage their money, but everybody needs to manage their money. And everybody needs to take a more active approach to their retirement, because it's no longer a nice to have, it's a need to have. You're responsible for your retirement. You're responsible for your wealth. You're responsible for your taxes. You're responsible for all these things. You cannot be like passively saying, let me see what's going to happen, and everybody's doing the same thing. You'll end up like everybody with not enough. So I'd like that idea of building your own portfolio and being more active. The only thing I would add, because this is what I do, is I help people do that.
Amazing.
Because I believe that a doctor, a lawyer, an entrepreneur, a high earner, even a high net worth business owner, whatever, doesn't necessarily have the skills to invest appropriately. They need people that can advise them on their behalf, and maybe have some skin in the game, something that makes it enticing for everyone, to make it so that they can access good properties and be able to because I've seen the other side of the coin. People that were a little bit too aggressive in 2021 and 2022 that now are underwater, and they might wipe out the equity that they had. So it's also about being careful and working with the right people. So I would say I agree with you with CPA and lawyers, but I would add an advisor that can help you understand a little bit more of what decisions you're actually making. Do they benefit you or do they not?
And one thing I would add is, if you're going to move from being a passive investor to an active investor, you really need to take an active role in understanding the money game and how the money game works, how to play chess and not checkers. And I would say that if you are somebody who is moved by the market and the news articles when they say, oh, the rates are high, don't buy, that is a chess style reaction if you're choosing not to buy based on that. And I'm going to give you a visual for those who are watching, and try and explain it to those who are listening. The market has 4 cycles. And if you follow Ray Dalio, how the economic machine works, you can watch a little YouTube video, you will begin to understand the money game. And there are 4 cycles, and it goes like this. Assets are low, so the cost of assets, homes, whatever, are low. Interest rates are also low. That's phase 1. That was like 2020. When interest rates are low, a lot of people have access to money. A lot of people can borrow money. So with a lot of people having access to money, they can then offer the assets and buy the assets and raise the price of the assets. I'll give you 10,000 more. I'll give you 20. I'll give you 20% more, 30% more, right? So that can artificially inflate the value of assets. So now you're in phase 2, where assets are expensive, but money is still cheap. Now, when the Fed sees all this money in the market, they start to see, oh, there's too much money in the market. Let's raise the rates so less people have access to money and there's less money in the market. So now we're in phase 3, where assets are expensive and money is expensive. So that we hit that probably a year and a half ago. So the next thing in the series, when less people have access to money and less people are borrowing and buying things because the news says, oh my God, rates are high, the sky is falling, less people buy assets. So then the asset prices start to fall back. If they were overinflated, they start to fall back to where they belong. So maybe right here in the middle, maybe not as low as they were, but maybe here. So now we're in phase 4 of the market cycle. So the logical thing in the series next is for rates to fall, because, oh gosh, there's not enough spending. There's not enough money in the economy. Let's lower rates so more people have access to money or more people spend. If you cement that in your mind, and you start watching the stock markets and the prices of houses and all these things, you are going to understand what phase we are in the market cycle. Now, Ray Dalio says that these market cycles tend to last 5 to 8 years on average. This one started in 2020. So now you have a strategy, you have a map as to, okay, well, if it started in 2020 and we're in year 2025, what do I think could happen next and in what time frame? Now you're able to make the decisions, right? So with my investors who are super savvy with this kind of stuff, they have all come to me to do cash out refinances, yes, at these high rates, because they want to get liquid so that they can buy, because remember, high rates are high. They want to buy these assets right here. You know, when it's like, oh, we should have bought when, that's like right now. You can always refinance when the rates drop, but you can never reverse overpaying for an asset. So if you watch the market, you'll kind of understand where you are, and you'll understand what moves to make in regards to stocks and assets and houses and all these other things.
Yes, 100%. I would add that there's a cycle myth that stops them to do the right thing, which is, but this time it's different. They say this cycle is different. And Ray Dalio says it's not different. It's always the same cycle because it's just a supply demand imbalance.
And it's a credit economy. We have a credit economy. Cycles happen in a credit economy.
Exactly. Exactly. And it's also, like you said, counterintuitive. You know, when everybody says don't buy, that's when the 1% buys.
Yeah.
You know, it's like
They buy it on sale and then they buy it with equity, essentially.
exactly. And then they can refi. And like I said before, it's no bad market, only bad strategies. And one thing that you said that's 100%, people should never overpay. Never, because you can correct that if you can hold it long enough. But there are people that overpay and it'll take them maybe 20 years to get back to zero.
Right.
So
But those are the
that is
people who are
very
playing
scary.
checkers. Those are the people who are playing checkers and getting caught up in the news cycle and the headlines. It's too late by then.
You mentioned that you live in California, but now you live in Miami. That is a bold move. It's one coast to the other. It's completely different. What drew you to Miami, and how did you face that change?
So remember in 2020 when I went around with and we had like 10 to 15 friends that would travel all at once. It was a bunch of couples and a couple of singles. We had so much fun, I have to admit. The second half was a good time. We kept going to Mexico though, because it's really close to San Diego. So we would go down to Rosarito and then we went to Tulum multiple times. The last trip we took, we were like, let's change it up. It's a birthday. We went to Miami in January of 2021. We were meant to stay a week. Half of us ended up staying 3 weeks, and 3 of us ended up moving out of this group of friends. And that's because I think when you go from Southern California, which is so closed and so regulated, and it doesn't make sense and it's not great for business, to somewhere like Miami, which has no income tax and is so open and so welcoming to business, you just kind of realize, number one, San Diego is not serving me to get to the next level of my life, and number two, why am I living in a junior varsity city when I could live in a varsity city? And that's just an easy visual to explain the difference in the two cities. Miami is very grown up. They're on their business. The energy is flowing. There's a lot going on. And what's interesting is since I guess you would call it the Pandexit, a lot of people moved to Miami. It's changed the dynamic. And instead of just being a models and bottles culture, it has attracted a lot of business conferences. We've got crypto that comes there, everything you can think of. Like there's a great conference every single month. There's music festivals for those who are into that. There's the spiritual community. There's the business community. So I just think it's a bigger city that has a lot to offer. And, for me, it's the water. I need a view of the water every day. And so I went from downtown San Diego. We were in one of the top floors with floor to ceiling windows to somewhere I went from the sunset to the sunrise, essentially. And yeah, in 2020, again, when I took a look at my life, I got to a point, I did a huge spiritual awakening, and it just sort of dawned on me that San Diego wasn't serving me anymore. That chapter of life I had achieved, I had gone through everything I needed to go through there. It was time to go somewhere else.
What advice would you give to people that feel what you felt, that varsity versus junior feeling?
Mhm.
And for you, you explained it very clearly, and Miami is incredible and you feel the energy, but what about the person that's still stuck? What advice can you give them?
So here's my story. I don't know what advice I can give you, but I can hopefully inspire anyone who's listening and asking for that answer. I left a marriage that was no longer serving me at the end of 2017. From that moment, I have been in what you would call nomadic or month to month situation. Now, I do not own a primary home, and that's part of my investment strategy, which people either really agree with or they really don't agree with. But for me, I did not want anything to be telling me no to an opportunity. I did not want any reason that I could not say yes to something I really wanted to do, especially after being in what I had been through for a decade with this person. So from that moment, even though I stayed in some places for 2 years, right, I always had the option to leave. So maybe that's a trauma response, but still, I wanted to give myself an out. I wanted to give myself, if this opportunity comes along and I can't ignore it, I get to go. So remember, strategy, I'm always thinking 10 steps ahead. So I set myself up from that moment to be able to say yes to whatever comes. So then in 2020, when I had my spiritual awakening, and I realized very quickly, I realized that San Diego wasn't serving me, and 2 weeks later I was gone because I had given myself an out years ago, right? So I guess what you want to do is you always want to have the option. You always want to have enough money. You always want to have the decision freedom to say yes to whatever serves you. Now, too, once I got to Miami, of course, in those 3 weeks, there was a networking group. It started off as a WhatsApp chat, but now we're on Telegram of nomads who moved to Miami from New York and California, and we would always have meetups and all sorts of stuff. So in those 3 weeks, I developed a group of friends where I felt safe and comfortable to then move to that city. So that was a piece that I left out earlier. So again, I gave myself the option by setting up a group of friends in January when I didn't move there until June. So I started in January and 6 months later moved to Miami, right? So all these little steps along the way is when I allowed myself to pivot and turn and say yes and be deliberate and decisive. Once I had something in my mind, I make a decision and I make it quick, and there's not all this ruminating. You got to trust yourself. So, that's really my story. Is I kind of set myself up for that. Interestingly, last year I lived in Thailand for 2 months because a group of friends, a group of entrepreneurs went. We got a big, beautiful home, amazing property, and we just lived there for like 6 weeks, and then I lived in a different part for 2 more weeks. So I got to say yes to that. I didn't look at these entrepreneurs and say, oh, I can't do this with you because I own this house and I'm stuck in this 9 to 5, and right, like, I have the opportunity to say yes. I have the opportunity to meet really cool people and do really cool things.
Love it, and very eye-opening for people who think it's not possible. You are inspiring them. For people that think that they cannot do it, you are showing them that it can be done. And it's all, and you say it casually, but it means a lot when someone says, not only did I gave myself the option, I was decisive and I took that chance and I did it. I'm sure there's a lot more into the spiritual awakening that you had that gave you that force. And even you had it before, but I think now you have more clarity. What's next in your life? What can we, you told us that you're starting a new business that you said you cannot say yet, but what else are you working on? What are you excited about?
I love to talk. It's probably my top favorite thing. And that's probably what has catapulted my business to where it is now, because I wasn't scared to get on social media and just talk about what I do. I think I might be one of the only DSCR lenders that talks about it as much. Everybody else kind of puts up these posters of what they've closed, and it's very formal. And you don't really get to understand or know the person or the nuances behind the loans. And so I love to talk on my social media. I also really love the idea of raising the vibration of the collective. And that's sort of a spiritual term in that I truly want to see everyone be happy. That's why I switched from the tech industry to doing these loans, because I want people to be happy. I do that by putting their money to work for them. I do that by providing loans that allow them to get into real estate much easier than some of the other options, right? And so for me, every one of my loans, I feel like, helps another family get to decision freedom, time freedom, money freedom, and therefore happiness. Because I really don't think you can be truly, genuinely happy as a person unless you can take 2 weeks off and go stay on the bedside of your dying father, which I did years ago, until he passed. I don't think you can be happy until when your best friend has a baby announcement, you can fly over and be part of that on a whim. And your friends invite you to Thailand to be part of an entrepreneur house, and you get to, right? Like, it can be, say you have a sick family member, you have the decision freedom to get whatever medical treatment you want, to fly anywhere in the world, or to take them wherever they need to go, right? That can be what decision freedom looks like. It can be anything from leaving a situation that's not meant for you, whether that's a relationship or a job. When you have money, you have the decision freedom to make yourself happy and to take yourself out of situations that don't serve you. And so with all that, I would love to probably launch my own podcast, interviewing others who have come through those realizations, who have had some sort of trauma and level up, and to explain how other people can achieve that in their lives, because I think that will lead you to true happiness.
Podcasting is only blessings. It's incredible.
Amazing.
So definitely you have a listener in me, and definitely want to see where you go, because you have a wealth of knowledge, and also you've given, like, I wrote notes and notes and notes and things of that is going to make me think. And people that listen to this or see this, I think they should follow you. And once you have that podcast, they'll listen to you, because I think there's a lot of experience that you can pass on, and inspiration, like you said, like not necessarily advice, but inspiration. Live the life you want to live, and you're the example that it can be done.
And you can follow me on socials at the Bridget Brick, TheBridget, Brick, Brick. Instagram, Facebook, TikTok, Twitter.
For sure. I
All
will
of
also put them in the description. And
Amazing.
thank you so much for being here and sharing your wisdom with us.
Thank you for allowing me to come on.
For sure. Thank you again.
Bye bye.